And good afternoon, everyone, and thank you very much for joining our webinar today. I think much like you, I'm amateur sports enthusiast and I've been engrossed in the Olympics over the course of the last week and a half. I'm very keen to hear from Paddy, his experience working with elite sportsmen. But in preparing for the webinar today, I'm drawing parallels between elite sport and investments. And I'm sure we'll hear from Paddy on this, and there'll be many synonyms and parallels to draw. Things like discipline, consistency, perseverance, I'm sure are things that are common in both fields. But it may be equally instructive to look at the inverse. Just thinking about it earlier on today, I was struck by the fact that, in elite sport, you would think that one is aiming for the exceptional by definition. And probably the starkest contrast with investments is that, we see our job really as making fewer mistakes. And I think the contrast is probably true and feasible only because in the sports realm, more often than not, one is competing against the clock and time is against you. And in investments, of course, the opposite applies. Time is very much in your favor. And that's something to harness. So with that in mind, sort of moving ahead, I thought I'd start with this slide, which is something that bothers me deeply, but equally so is quite fascinating. How the average investor deals with uncertainty. This slide, I think, depicts the fact that clearly not doing a particularly good job. What this reveals, it's from a consultancy in the US called Delbar, who analyze every year US mutual fund returns. On this slide, you see the return of the average balanced fund or asset allocation investor relative to their opportunity set. And the underperformance is quite stark. I've highlighted there in the middle a sort of typical balanced fund benchmark. And one would think, firstly, that fees would play a large part in the underperformance. That's not the case. In fact, it's investors' own behavior which explains almost the majority of the underperformance. So clearly, investors themselves are prone to behavioral mistakes that leads to this sort of outcome. And clearly not managing the uncertainty presented or in the environment in which they operate. If we look at the experience of the average professional, doing slightly better, although measured differently here, what I show here is the return of the average large cap equity, global flexible and balanced funds as tracked by Morningstar relative to the MSCI World. And it's quite noticeable that clearly multi-asset or balanced funds have the benefit of diversification, which comes through quite strongly. So that is something that struck me. Clearly, the ability to guard against major drawdowns in 2001 and again in 2008 in the midst of the financial crisis paid off quite meaningfully in the subsequent years. Although it's clear also that arguably balanced fund or multi-asset investors, particularly flexible fund managers, have been relatively conservatively positioned over the last 10 or so years. But even so, over a 30-year period and after 12 years, give or take, bull market, the equity market is now only sort of exceeding the return from the average flexible fund. So clearly, diversification is one way to navigate uncertainty. And as a reminder, why we diversify. Firstly, I think to expose ourselves to a greater opportunity set, to reduce or lower correlation within our portfolios and to reduce volatility. And that allows us the ability to target risk-adjusted returns, which I think are quite important in ensuring that investors remain on board, because volatility very often is the thing that frightens them away. And I think you've seen from the Delbar slide, volatility clearly was instrumental, I think, also in some of that investor behavior. But lower drawdowns, clearly from the previous slide, also gives one the ability to compound returns, which over time, point I made at the outset, clearly makes all the difference. But diversification, in essence, allows us to develop some sort of asymmetric return profile, which within our flexible fund certainly is something that we target. And that means giving up some return for significantly less downside, or any other sort of profile that one chooses as an investor. So just thinking about that a little bit more, I wrote an article recently, which we published in our quarterly, where I showed the results of this exercise, the compounding effect of systematic asymmetry, which on a spreadsheet is quite easy to model out. In practice is very difficult to achieve. But essentially what we're illustrating here is the asymmetry, which I mentioned, and the dotted black line is a sort of notional portfolio wherein which we simply modeled 80% of the MSCI World's positive returns, but importantly, only 60% of the negative returns. So you get a profile of a portfolio that has 80% upside capture and only 60% of the downside. And that asymmetry over time compounds into significant outperformance. And that's exactly what we're looking to achieve within our own flexible fund. So while we don't have a 30-year track record, strategy was launched a little over 5.5 years ago. We have, by and large, kept pace with the equity markets. The red line here reveals the fund return since inception. For most of its history has matched the equity market return. It's only really over the last sort of 6 to 8 months where those have diverged. But on the right-hand side, I show there the upside capture and downside capture ratios, which roughly speaking resemble the 80-60 asymmetric profile I modeled out in the previous slide. I'm quite comfortable that in the fullness of time and a full market cycle, that if we are able to continue to deliver this sort of profile, that the red and blue lines converge once again. Most likely that the red line catches up to the blue line as equity markets consolidate and roll over, and that the downside protection that we believe our strategy offers really compounds over time to deliver significant outperformance. Certainly that's what we would be looking to achieve. I should say that the turquoise line, which references the right-hand axis, reflects the underlying equity exposure in the fund, and you can see as markets have moved higher, we've continued to reduce exposure directly to equities, and over the last year and a half or so, we've had relatively dynamic exposure to equities as the market has presented more opportunity. In terms of the risk-adjusted return metrics on the right-hand side, Sharpe ratio, Sortino ratio, I think what I'm most conscious of is the returns, like the Sharpe ratio, which accounts for downside volatility, and the Kalmar ratio, which shows excess return relative to maximum drawdown. And those, I think suggest, certainly reveal very strong risk-adjusted performance from this fund relative to peers, which gives me some comfort that we are on the right track in delivering on that asymmetry. So you might ask then, well, what are the sources of asymmetry? And one would think that asymmetry is really a lack of equivalence. And first thing you think of is, and I think most people have this impression, that fund managers have access to information that nobody else is privy to. there are sort of deep insights that we glean that others may not arrive at, or that there's some sort of magic formula that we apply. I think in an informational age that we live in today, information is largely democratized, and actually that asymmetry is really a behavioral one. And I think why the example of the average investor in the early slides is so poor, because they are prone to their own sort of behavioral issues. And so as dispassionate professionals, we're trying to ensure adherence to a very disciplined process to ensure that that is not the case. But as it relates specifically to our fund and to our process, I think the first benefit or source of asymmetry is the fact that within the flexible mandate, we don't have to be fully invested, and we have the ability to diversify across asset classes. And that means we can both harness returns and lower correlations. In terms of our approach to investing in equities, we insist only on investing in a small group of competitively advantaged companies. And I think our process that we've built and enhanced upon allows us to integrate both fundamental risk and valuation, and putting those together in a portfolio context has great sort of sources of asymmetry. Another way of dealing with uncertainty is, not to believe in point estimates, that the future is really just one of many potential outcomes, and even some pretty unlikely outcomes. And therefore, the approach that we take is probabilistic, scenario-driven. We build pre-investment case, bull, bear, and base case investment theses. We value companies accordingly, so we'll have a bull, bear, and base case intrinsic value estimate, and then by applying a probability weighting to each of those, I think it informs very much the risk-adjusted expected return. And then, we're in a position, I guess, having 100 companies on our global buy list, to benefit from real-time proprietary bottom-up valuations. And that means that we can act very, very quickly to give expression to that buy list within the portfolios. So I'm pretty sure we'll hear a lot of this from Paddy also, but in my estimation, at least, where there might be a lot of commonality with sort of elite sports people is, a very disciplined approach to, or an adherence to process, controlling that process and allowing the outcome sort of to take care of itself. So, wrapped up in all of this is the acknowledgement and the acceptance that the environment we operate in is inherently uncertain, and therefore we plan accordingly. So in terms of sources of asymmetry, and just to elaborate on that, the first one, not having to be fully invested within the flexible mandate clearly has great benefits. You can see over the course of the strategy's track record that while we've been largely exposed to equities, there has been sort of some dynamism around accessing other asset classes. For the first year and a half, 2 years of the strategy's existence, we had no exposure to bonds. We introduced them midway through 2018 for the first time, as US Treasuries yields went over 3% for the 10-year. And we then sold them out, reintroduced them again. We introduced credit for the first time in the wake of the sell-off last year, as spreads widened, subsequently reduced that exposure again quite meaningfully. All the while, we've also been quite happy to retain relatively high cash balances in the portfolios to account for periods where we have felt that intra-asset class correlations perhaps didn't offer the diversification benefits we were looking to harness, or dare I say even that valuations sort of made no sense to us. So cash has featured quite prominently in the portfolio within the fund as a volatility buffer and a sort of from a principle of, first do no harm. Second point, relating to which I think is a strong source of asymmetry, is a philosophical one. I said that we insist only on investing in a small group of competitively advantaged companies, and I think an insistence on doing that within a very disciplined valuation framework clearly has benefits. We model that out here, and so what you see here, the orange bars, represents the returns from our quantitatively constructed portfolio. These are the stocks that rank most highly from our screening process, which teases out quality through looking at various return on capital and free cash flow measures, as well as sort of a high level indication of value, looking at implied in perpetuity free cash flow growth, EV/EBIT multiples, and free cash flow yields. And what is quite striking to me is that for no period longer than three and a bit years, you see no negative returns from our quantitatively derived portfolio. And and there's a wonderful asymmetry exhibited here in that through the Northstar global quality and value model, you see higher highs and higher lows. So more upside and less downside, which is sort of the ultimate asymmetry. It's important, I think, to mention also that a fundamental, forward-looking, active approach to factors such as quality and value clearly stands one in far better stead than looking just passively in a backward-looking sense at quality, as represented here by the MSCI Quality Index, the red bars, as well as the market overall. Then, I made the point that portfolio construction lends another source of asymmetry. What I show here is an illustration of our buy list in real time. This is actually from earlier today, funny enough. The bubbles represent all 100 stocks on the buy list. The size of the bubble, the risk rating, is the rating our investment committee ascribes to each one of those stocks. The larger the bubble, the less risky we think that company is. The smaller the bubble, greater the risk, fundamental risk that is. And on the x-axis, we show the difference between our bull case intrinsic value estimate and the bear case. And that represents valuation or forecast risk in our minds. And on the y-axis, we show the expected returns over the 3-year period. And as the portfolio manager, what I'm looking to do is to consistently skew things in our favor to achieve that asymmetry by dragging the red dot in the middle, which represents actually our current equity portfolio, dragging that red dot and optimizing the buy list to the top left-hand quadrant for a higher return and lower risk. So we can do that in real time, and at every point where we're looking to rebalance the portfolio, we will take account of all these metrics to drive or to drag that red dot closer to the top left-hand quadrant. Another source of asymmetry, and I think a very important one, lies in portfolio construction and managing risk. So for many people, I think the notion of fund management is simply making a stock selection or investment decisions. And security selection, at least in the broader sense, is an important part of that. What I show here, both on the left and the right-hand side, the bars represent annualized alpha outperformance of the MSCI World of our own global equity portfolio, and as it relates to the underlying equity component of the flexible fund. You can see we've consistently outperformed the MSCI World, with the exception of 2014. And we've done that firstly through consistently good stock selection. So a hit rate representing the number of holdings in the portfolio outperforming the benchmark, consistently of about 60%, 70% in 2020, 2021, a little disappointing in that respect. But selection is only half the job, and I would argue that it's less than half the job. what I show on the right-hand side, and I think where we've seen the most improvement, and the benefit of sort of evolution of our own process, is in the construction. So referring back to the bubbles on the previous slide, how we package the portfolio, put it all together, and ensure that we're taking adequate exposures and sizing positions appropriately for the inherent risk that we face. So the win-loss ratio is simply the weighted average alpha, or the weighted alpha from the stocks which outperform, divided by the weighted alpha from the stocks that underperform, the negative alpha. And if you're constructing your portfolio correctly, even in a year such as this one, year to date, that's to June, where you have less than 50% of your holdings outperforming the benchmark, if you're constructing your portfolio sensibly, you can still achieve a positive win-loss ratio and therefore positive alpha. And I'm very encouraged to see that, in an environment where perhaps because of different style drivers within the market and strong performance from cyclicals and perhaps areas of the market where we have traditionally been underinvested, that we've nevertheless still been able to achieve our performance, and that is quite encouraging. So I think stock selection, but more importantly, portfolio construction lends fantastic asymmetry. I think because of that, the evolution in the process and perhaps better risk management, understanding portfolio construction better, we've been able to improve on the performance of the equity component of the fund and our global equity mandates in all market conditions. So what I show here is the red bars, the solid and the sort of outlined ones, represent Northstar's own equity returns since 2013, beginning of 2013, and since 2017, when we had the opportunity to broaden our buy list quite meaningfully, versus the MSCI. And what you see there is that average 12-month rolling alpha has improved, so the white blocks relative to the gray blocks, in every market environment. So we've outperformed by a little over 4% gross of fees since 2013, but by 7 and a bit since 2017. But if you break that down and you define sort of strong markets as 12-month rolling returns of 10% or more, and moderate returns of between 0 and 10, and then falling markets, naturally negative returns, I'm very encouraged to see that in all those conditions we've done better, and I think it sort of goes back to the previous slide, and better construction and probably also a broader choice. So that again also gives me very sort of underscores the confidence we have that we will continue to be able to deliver significant outperformance at the underlying equity level, and probably most encouraging if you look at the middle there and the moderate market environments, which I would argue is probably the most reasonable one to expect over the next number of years, given where we find ourselves from a valuation point of view, that not only our stock selection, our ability to identify good opportunities, but also the optimization work and construction work we've done and are applying, that it puts us in a relatively strong position to continue to outperform. And so all of that sort of rolls up into the outcome. We've talked process to date, and the outcome is really one that where we can say over the last 5.5 or so years, the fund has outperformed all reasonable benchmarks. Probably the most important one ultimately from the investor's point of view is the absolute one. We think an US dollar inflation plus 5% hurdle for a mandate of this nature is appropriate. But equally, a composite benchmark comprised of equities and bonds, your typical balanced fund benchmark, as well as either the local ASISA flexible, multi-asset flexible peer group, many of whom have significantly higher equity exposure than we have typically carried in our fund, as well as the gray line, which is the global Morningstar flexible allocation fund peer group, all 200 odd managers or funds available for you to choose from. So over time, we've delivered a return in excess of 12.5%. We have delivered a return consistently sort of top quartile and over longer periods in the top 5 or 10% of global funds, so ranking relatively highly relative to peers. So in conclusion, I'd say what we offer and what our fund proposition really is to you as potential investors is a forward-looking, fundamentally focused and valuation-driven approach with a strong global stock selection track record, which speaks very loudly through the fund. An experienced team to draw from. We have I have 2 dedicated global equity investors, analysts working directly with me. I have the ability to draw from our fixed income team, Mark Seymour and his team. They have direct input on the fixed income component of the fund. That has allowed us also to take a very systematic approach to tactical asset allocation. We're drawing from proprietary bottom-up global equity and global bond buy lists. And all of that combines into a truly active approach to managing the portfolio. And ultimately, we think a return profile which is equity-like in nature, but with significantly less downside.